That. Okay, looks like we're recording. I don't know why it didn't say we're recording. All right. And then, okay. Jeff, you got my screen? See the full screen?
Yeah.
Okay. All right. Well, we've got a couple more coming in, but I'll just go ahead and get going and we will just had some chat, but those are people, yeah, recording it. Okay. All right. Well, welcome everybody. Thanks for joining. I'm glad to have you all here tonight. We are talking about our next investment opportunity, which is Pine Bridge Apartments. This is threefold, and we are partnering once again with our great partners up north, LV5 Capital, and Jeff Dolmage, who many of you know, is joining us, and he's going to talk to us about their team, and I'll just kind of give you a little bit more as we go on about our partnership. Yeah, happy to be in partnership with them again. It's been great on the two deals we've done already, and
Great
look
starter.
forward to another good one. All right, so got some legal stuff here. These are just projections, a pro forma, forward-looking statements. So you should take all of this with a grain of salt. Review this. I'm going to talk more about that, all the documents that are involved, but this isn't. We're not selling securities tonight. This is just a presentation, just to give you an idea of what this investment's like. We've got a lot of other documents that you have to go through before we're going to sell you shares in this investment. So, the agenda for tonight, I'm going to tell you a little bit about threefold. Not going to spend a whole lot of time on that. I think most, if not all of you, know threefold pretty well by now. I'll let Jeff talk a little bit about LV5 Capital. Probably most of you also know LV5 Capital by now. This is the third deal we've partnered with them on. I'm going to tell you why we love Pine Bridge, our plan for this property and for this investment, how you fit in, and then your next steps. So, again, many of you know threefold, so not going to waste a lot of breath on this, but we did start back in 2017. We did a flip here in our hometown, Lebanon, Ohio. We quickly scaled. We knew we wanted to get into multifamily. We knew we wanted to scale, so we did a duplex the next year. Then we got into a 16 unit. Today we own 750 units, so some bold growth over the last 8 years, but we've really maintained strict standards. And I think the best example of that, as many of you know, we've gone a year twice, once 12 months, once 13 months, without buying anything. It's been very hard to find great deals over the past couple of years. And so, some of you know that it was October of 2023, and then we didn't get another deal until November of 2024. That was Bell Meadows that a lot of you partnered with us on. So that's 13 months. That's one example. So we're really principled. We only buy properties if we think it's a great deal. We've gone full cycle on a few, and we've got a portfolio. Jump to the next slide where I kind of show some of that. So the top chart there are the deals that we've gone full cycle on. Those first three were small, timed the market well. We'll never hit those numbers again, so don't look at those numbers too seriously on that first line. But then the next three were some syndications that we did that a lot of you were involved in. Pretty happy with how those turned out. We definitely had some struggles, had some fires, had big tax issues on all of those. So none of them went exactly according to plan, but we're happy with how those turned out. And then the properties on the bottom, those are the five syndications. Those are the five projects that we currently own. LV5 Capital partnered with us on Elida 96 and the villas. And so, what I'd say about those, while it looks like our distributions, have gone very well, they have, but it's been a tough few years to operate. Things have been challenging. Income has been pretty flat for a couple years. Expenses are not flat. Expenses are up. As you know, interest rates are up as well. Fortunately for us, we only use fixed rate debt, so we've not run into any significant interest rate issues on our current stuff. But it's still made purchasing challenging, of course, when you're paying the bank more. But operations have been tough, and so we've been really happy with how we have been able to perform on our current deals. But it's been challenging, and I think those challenging times have just made us better, made us look at things more critically. I mentioned on those ones that we sold up top there's some tax issues that we've gone through, and I'll share later on this one. That goes into our underwriting. We've experienced taxes going up and going up significantly, and so we underwrite that way. So you'll see that in our underwriting. So that's a little bit about Threefold's history and some of the deals we've done. Again, a couple of these being with Level 5 Capital. So our team, really want to brag about our team. I feel awesome. I feel great about our awesome team. My wife, Hannah, many of you, if not all of you, know her by now. She's very much involved in the business. She's incredibly talented. And I have to say, I would hire her and work with her even if I did have to pay her. Fortunately, I don't have to pay her. She works for free. So that's nice. But even if I did have to pay her, I would hire her. Lauren and Karen, we do pay. And they're incredibly talented as well. Lauren has been awesome. She's been with us 5 years. I'm looking at Hannah. She's been with us most of the time. Started pretty small, but then has grown with us, and it's been great to have her counting every cent, making sure everything's accounted for, keeping our books and all that. And then Karen is she acts as a regional manager, and she'll really go anywhere, do anything that we ask her to do, and that's incredibly valuable. She's just really bought into Threefold, so we've just got an awesome team. Makes it really fun, and that's allowed us to become class managers. I really do believe we've become really good at asset management, managing the investment, the properties from a high level. But then, we started into property management just over 2.5 years ago. And I think we've become really good at that as well. We're solely focused on our properties. We don't manage for anybody else. So it just really allows us to be laser focused. We've built a great team. We now have 20 employees managing our 750 units. And then really proud. I feel that we've always been very open and transparent with our investors. Hopefully those of you that have partnered with us feel that way. We do quarterly business reviews. I'll talk a little bit more about that later, but we're just, always try to be very upfront and transparent with all the financials and everything going on at the property, and always answering questions whenever those arise. And as I mentioned, it's been tough. It's been a tough few years to operate. Things have not gone as planned. We've had some tax hits. We've had some fires. We've missed a couple distributions on several properties. Most of them were the ones that we sold, but you saw on Williams Point on that one, we missed some on that. We had a giant sewer backup. We're very upfront with that. We lead with that. We let the investors know exactly what's going on. And I think that's really important. And we're proud of that, of our business as well. So that's a little bit about Threefold. Jeff, why don't you jump in here and tell us a little bit about Level 5 Capital Partners. Again, we've partnered with Level 5 Capital on 2 deals, Elida 96 and the Villas. This will be our 3rd one. I met Jeff, at least about 4 years ago. Just Jeff and I, and then his partners Dave and Doug. We just really see eye to eye. Have very similar values, very similar strategy, the way we look at investments. And what's been neat is I've gotten to know not only Jeff and his team, but his investors, many of you on this call, and we've done some dinners. It's neat because it just seems like a lot of the same people that Jeff and his team attract to their investments as what we do here at Threefold. So it's just a great relationship. So Jeff, do you want to jump in here and tell us a little about your team?
Yeah, I don't want to take a lot of time, but we're just super excited to have the opportunity to partner with you again, Lee, on this deal. We've helped Lee through more of the process on this one than ever before, and I'm grateful for that opportunity. Lee and I went and visited the property before we even put the offer in a few weeks ago, and then after we got our offer accepted, we were a part of the inspection team that was on the ground going through all 180 units, and we appreciate that because it gives us the opportunity to really get sold on a property, to get our hands dirty, so to speak, and get, right there and just really understand a property. And I would say that I'm as excited as any investment I've ever looked at with this deal. I really believe that it's at a great location. It's a great property. We're buying it from really great sellers, and I feel like it's just going to be a phenomenal opportunity really for your investors and our investors alike. And I feel like it's a really safe play, but also a nice cash flow play. So we're really excited. Like I said, Doug, his son, Dave, and I all were a part of the inspection, and so that was really neat. And we're really grateful to have the opportunity to partner with Lee and his team. We think the world of them, and so it's easy when Lee asked me to participate with him. It's easy to see the common ground.
Good. Anything else on this slide, Jeff? Anything else you want to say about your team and your
I
guys'
mean, just
experience?
we've been in a whole bunch of different aspects of real estate. I at one time I owned a brokerage and I grew a property management company to managing over 400 units. I've looked at literally thousands of multifamily units. So when I get the opportunity to go and like we did with Pine Bridge and go in person, I'm comparing it to literally probably hundreds, if not thousands, of other properties that I've seen. And so all that experience I feel does bring a little bit of credibility and help to you and your team. And so we're just, like I said, we're just grateful to have this opportunity and really believe in you and your team. And we're excited for this one.
Absolutely. No, we're excited to have you guys, Jeff. It's been, again, I've kind of said it's been great partnering with Level 5 and excited to do it again. Jeff and his team, Dave, Doug, they bring a ton of experience, and I need that. It's great to have these guys looking at the property a little bit differently, asking different questions. So going in, it's great. And then as we have been operating, I get a lot from Jeff and his team on just their experience. The one that we have up in Lima, which is real close to them, the stuff that we have up in Northwest Ohio, Northeast Indiana, just been great to work with them. So excited to have them, excited to have their investors along with us as well. So some highlights on Pine Bridge. Let's jump in here to this investment. Jeff hit on this a little bit, but the seller of this property is out of Columbus. He's actually become a friend of mine. So that's kind of interesting, buying from a friend. I do feel like he's been very honest with me. But of course, we're, still do our own due diligence and all that. But they are good people. They're good operators. They've done a good job, but they just want out. So they had told their investors this would be a 3-year hold. That's a very short hold. It's been over 5 already. So their investors are antsy. They're ready to get out. We're actually buying this property for what the sellers have into it. So the sellers had they bought the property for $9.5 million. They put 1.9 into it, so they're into it for 11.4. And I'll get into this on the next slide, but that's what we're buying the property for. So they're not distressed, but they really do want out. They understand they're selling. Their investors aren't losing any money, but the general partners in the team, they're not really making anything. So we just really feel like that tells us we're getting in for a good deal when we are getting it for what they have into it. Another, some of the other metrics, just high level. Again, I'll get more into these, but it's better than a 1% rule. 1% rule means that you should rent for 1% of what you're buying per unit. And so since we're buying for about just over 63,000 a unit, and we're renting for the average rent is 792, and we're doing better than that. That's 1.25% rule, which is really good. We think these are great buildings. They have attractive layouts, big kitchens, private patios, good green space. It's a good location. This is a big town. Either a small city or a big, I guess I would say it's not big enough to be a small city. It's just big enough to maybe called a big town. Lots of manufacturing, good jobs. I'll talk about that later. It's right off 71, 1 hour from Columbus. And then, of course, we love cash flow. You guys know we are cash flow buyers. Our investors like cash flow. And so that's what we're looking for. This one we believe is going to provide over 8% cash flow in year one, over 8.5% for the first 5 years, and just a lot of good cash flow, a lot of good upside as well. So we'll get more into that, but just some high level numbers. Again, purchase price $11.4 million. This is a 180 unit multifamily property. So we're getting it just over 63,000 a unit. The cap rate is 7.7%. So really happy with that cap rate. And considering we're looking at interest, interest on an interest rate on our loan of about 5.3%. Actually, the brokers think it's going to be 5.25, but I've got it 5.3 in the underwriting just in case. That gives us 2.4% of positive leverage, meaning that our cap rate is 2.4% higher, or 240 basis points higher than the interest rate. When you can do that, you should cash flow well. That gives you got a good spread there, right, on what you're borrowing at and what you're purchasing at. So we're really happy about that. Talked about the average rent, 792. That rent divided by the price per unit, 1.25%. That's a great number. Market rent 839. So there is some upside. There's not a lot of upside, but that's kind of, I think, where Jeff was talking about. This is, we feel like a relatively low risk deal. We're not trying to do something crazy at this property, reinvent the property. We feel like the seller's actually done a good job and has got some good momentum here. We want to continue with that. We actually think there's some things we can do on the expenses side. So we feel good about that rent premium. We think we can go get that, but we don't have to do anything crazy to get that. And we're not trying to push rents by a ton. I don't think it's a great time in the market cycle and the economy right now to be pushing rents a ton. We're seeing that at other properties. So we actually like that, we're not going to be trying to push rent a whole lot. And again, I already talked about, great cash flow in year one. That spread, I'm going to talk about that later. We're going to have two investment classes for this one, as we've done on previous investments. We do like the location. We like to be within a half day's drive of our properties. This one's 2 hours from us. I highlighted on this map also Lima and Bellefontaine, because we own in those two areas. We own a 96 unit just west of Lima, and then we own a 120 unit in Bellefontaine. Many of you have partnered with us on those. Similar towns, similar type locations. Lima is when I looked up, I put it on, maybe I put it on a later slide. I'll talk about that later. But about the same distance. So this is our wheelhouse, buying value add multifamily properties in tertiary Midwest markets. This is what we do. Mansfield's another market just like that. We believe it's attractive to tenants because it's got a small town feel, low cost of living, good jobs, quick access to the highway. So we like those things. We thought that about Lima and Bellefontaine as well. We do have strong household income here. It's better than 4 times our target rent, which is good. I'll talk a little bit more about that. And the tertiary markets are more landlord friendly, lower taxes, less restrictions, quicker evictions. So we like those things. It allows us to operate better. A little bit about the people, which, just population, the income, the jobs. Mansfield was an area, and Jeff knew kind of some of this background too, as Jeff in a previous career was selling in Mansfield and was kind of telling me about this. This is an area, a town that did kind of get hollowed out, and really the population actually from 1970 all the way up really until the 2000s was declining. That has been turned around, and now population is growing. As you can see there, it's up 3.25% since 2017, up just 0.12% per year recently. Now, that's not much. I admit that this is not a high growth area. Neither are a lot of the other areas that we invest in. But we're comfortable with that. These are steady areas, as a lot of Midwest tertiary markets are. But we like slow and steady because the developers don't come into these areas and build a ton. A lot of the areas that have the high growth, that's where they're doing a ton of building, and they get overbuilt. And then you have other problems. So there's no new development going on in Mansfield. And so we like that. Again, a similar area, I've kind of brought up Lima, Bellefontaine. Lima population is about 35,000, Bellefontaine 14,000. We have a bunch of units in Auburn, Indiana. Population there is 14,000. So population almost 50,000. This is, a bigger town, but it's similar to what we do. And there's that median household income over 46,000, based on what we're targeting for rents. That's very healthy. That's up 4% from the previous year. And I think these stats were from 2022 and 2023. A little bit on some of the top employers. There's some good manufacturing. That Ohio Health, and then there's a Vita Health Systems as well. Those are the big healthcare systems. Those are growing. We've got Charter Next Generation. That's CNG. That's North America's leading independent producer of high performance specialty films using flexible packaging. So that's a packaging plant that employs over 1,000 people. This is a new, this 179th cyberspace wing. That's a new, it's the first cyberspace wing in the Air National Guard. Newman Technologies, that's automotive manufacturing as well. They do car doors and exhaust systems. You got this, I'm not exactly how to pronounce this, but ArcelorMittal. That's a steel manufacturing. They're one of the world's largest producers of pipe and tube products. And then Stone Ridge, another automotive manufacturing plant, Gorman Rupp. They manufacture pumps. They've been there since 1933. They have an 825,000 square foot facility. Yeah. And then we've got J Industries that does stamping and tube manufacturing. So a lot of good industry, a lot of, I think well diversified, some smaller, but some that have been around. So we're happy with that, with the population, with the household income, and with the top employers in the area. So that's some of what we like about the area. The buildings, I've probably told many of you, I've said this on others, but I really like brick buildings. I don't like flat roofs. I don't really like basements underneath the units. These buildings are all post 1970, so we have no aluminum wiring. We have very minimal cast iron plumbing. Talk about that a little bit later. But these are brick. We've got shingle roofs, no flat roofs. Like that. The amenities, some units have washer dryer hookups. They all have private decks. There's 2 playgrounds. There's a dog park. There's a lot of green space. There's plenty of parking and good unit mix, mostly 2 beds. We really like the 2 beds. They're very versatile. 1 or 2 people can live in them. You can have a small family in them. So, and I think the floor plans are attractive, will be attractive to residents. There's some kind of the layout of the property. There are 15 buildings, all 12 unit buildings. So very uniform. The inspection, Jeff talked about this. There was a team of 7 of us. So yeah, Jeff, Dave, Doug's son, me, Hannah, my father-in-law, and then a professional inspector. And then, the on-site team that's there currently walked us around. So we were able to get into every single unit. I don't know that we've ever been able to get into 100%, but this is when we were. Our inspector then, he inspected all 15 roofs. We had the sewer lines inspected. That was actually my biggest worry, just because you can't see it. The inspection day went very well. Honestly, it went better than expected because the units were just even in better shape than we expected. New kitchen cabinets, tile flooring, things like that. But the sewers, I thought, man, this is the one thing that can submarine the whole deal or just change it a lot. And they're in great shape. 3 buildings do have cast iron under the buildings, and then turn into clay pipe, but the cast iron's all in great shape. So it's something we'll monitor. But right now, the plumbing company that cambered it for us, said it was in great shape. And then the other buildings are all PVC, which we really like, and they're in great shape. And then all the clay was in great shape. So really a great report there. So that was great. The roofs, are new. They were all put on in 21 and 22. Also have new sidings. The parking lot's been kept up. It is in pretty good shape, and most of the decks are in good shape. But we do plan to do some of those, and I'll talk about that a little bit later. So about the units, I put here small but mighty because these units are smaller, but most of them are 2 beds. And what I would say is residents do care more about how many bedrooms than the square footage. Now, would they take a 2-bed unit that's more square footage if it was the same price? Sure, but they're typically not going to be. So this property kind of benefits from having a lot of 2-bed units, and even though they're smaller, you're going to rent smaller units for a higher per square foot basis. And then another thing I like about this, just looking at our competition, is that just the high occupancy, right? So you can see that these properties around here are at high occupancy. So I dug in a little bit more and just looked at the 2-bed units. Again, you can see here that our competition are mostly significantly bigger. And so they are renting for more. So there's their current 2-bed rent and then what we're targeting. But the current ownership is already getting this. And so we feel confident that way, but we feel confident also looking at our competition because yes, again, would you rather have an 850 square foot 2-bed unit? Yes. But if it's still 2 bedrooms, still got one bathroom. Again, they don't have in-unit washer and dryer in theirs. There's not a lot of amenities at these. These are very comparable properties, just a little bit bigger. So I think what Pine Bridge is benefiting from is people are saying, well, yeah, it's a little bit smaller unit, but it's still 2 beds, bathroom, nice kitchen, got a deck, got plenty of parking, good green space. We'd rather rent that. And so I think that's why they're doing so well. And so we expect that to continue. Here's a picture of the kitchen. I mentioned that. So not the not the seller, the current owner, but the previous owner put in all those cabinets and put in tile flooring in the kitchen and bathrooms. Actually put in all new water heaters, all new furnaces, all back in 2015. So there's really very little to do in these kitchens, and that's typically where you're going to spend most of your money when you're renovating a unit. So we're really happy about that. There's proven upside at this property because the current ownership, they've been increasing their leases at renewal by an average of $66. They're having a lot of success with that. They have very high occupancy at this property. Again, like I said, they're good operators. They've done a good job. They're just ready to get out. I mentioned before, another reason we feel good about our competition is that there's not new competition scheduled. There's been no new deliveries, so no market rate multifamily properties have been built in this market since 2020, and there's none currently in the pipeline. So that's good for us. That's good that there's not more competition coming. So we feel good about that. More pictures here. Nice bathrooms. This is an example of putting LVP in the living room area. There's some that have carpet. We tend to like the LVP in the common areas, and then keeping carpet in the bedrooms, as you can see on that bottom right picture. So our plan, purchasing for 11.4, we plan to get a 75% loan with either Fannie or Freddie. We're currently getting quotes from both of them right now through Bellwether. Bellwether is a broker with Fannie and Freddie, and they currently have the loan on this property. So we're working with them, and we should have those numbers shortly. I was hoping to have them back from Freddie today, but we didn't get it today. So should be any day now, and then Fannie right behind that. But that's what we're looking at. Again, right now they're saying 5.25% interest. So I underwrote to 5.3. If we get 5.25, great. Our numbers will be better. So with that loan at 8.5 million, we'll need 2.8 million for down payment. We've got around $400,000 of closing costs. We want to have 525,000 in our kind of CapEx account, and then the leftover money would just be in an operating account along with the CapEx fund. So the total equity that we're going to raise is 3.9 million from you all, from our investors. What we like is about one extra thing that we like about this setup here is that we are raising the capital for the down payment. We're also raising all of the capital for the CapEx projects. And so we can control that process. We can keep the money. So, while we're 75% loan to value on the purchase price, when you figure in all the money we're putting into it, our loan to cost is under 70%. So feel good about that. Want to be upfront with you guys about our fees. We do take a 2% acquisition fee, which is 2% of the purchase price. That goes into the closing cost there. I think most of you know that, but that's, between Jeff and I and our teams, that's kind of what pays us our salaries and allows us to do this full time. Bonus depreciation. We've done this on most of the deals we bought. We plan on doing bonus depreciation here. I already had this deal looked at by Cost Aggregation Services. They've done a couple projects for us. And so here's kind of what they're anticipating as our total depreciation. And then, the limited partners, you guys are going to own 60% of this deal. So you get 60% of the depreciation. We get to take 100% bonus depreciation in 2026. So what we're looking at is for a $100,000 investor, your depreciation will be somewhere between $27,000 and $42,000. That's kind of the low to the high end of the range that CSSI gave me. And so you'll be able to use this depreciation against passive income. So if you have passive income from other investments or just the passive income you have from this investment, you'll be able to use this depreciation against that. And so there's an example of tax savings for somebody in a 37% tax bracket or 22% tax bracket. And then whatever you don't use in 2026, you'll be able to carry over. Most of you have kind of an understanding of syndications. Have done a syndication with us before, but we're using 506B. Regulation D506B syndication. That means we can take accredited and non-accredited investors. You do have to have a relationship with Threefold or Level 5 Capital, which all of you do. That's why you're on this call. The equity split, the profit sharing split on this investment is 60% to all of you, to all of our investors, our limited partners, and 40% to Jeff and I and our teams. We are giving a preferred return to you limited partners between 8 and 9%. I'll explain the difference there. And our minimum investment is $50,000. So we've always felt like our interests are aligned with this setup because with the preferred return, all of you, the investors, the limited partners, your return is prioritized. So with that preferred return, you're receiving 92% of the cash flow in years 1 through 5. So you're getting paid first. That protects you. It's not guaranteed, of course, but it's prioritized. So you're getting that first. And then the sponsors, well, obviously we're only getting 8% of the cash flow in the first 5 years. We get 40% of the upside. So if we do well, if we do well for 5 years and we can get all of your capital back to you, then we get 40% of the cash flow. And when we sell, we get 40% of the upside. So we're really, incentivized and kind of forced to do well for you all for a long period of time. And then we get to do well. So I that's why I like the setup of a syndication and how we set it up with the preferred return. Again, I'm checking the chat here, but I don't see anything. But feel free, to jump in anytime you have any questions. I'll keep going for now. Why is that? Okay. Our plan as far as property management, we will use Threefold Property Management. Kind of mentioned this before, and I think most of you know this. We have in-house property management. We think we have a great team. So Threefold Property Management will be the manager of this property. There is, a team on site, obviously, a current team. The seller, again, who I know pretty well, speaks well of his team. He admits, and I noticed right away, that they are overstaffed. The seller owned other properties in the area. He's sold off everything. Another part of the story is he's getting more into development. And that's why he's just ready to be done owning, value add multifamily like we do. He's now moving more into development. So he's sold off his portfolio in this area, but he's kept a lot of the staff. So it's overstaffed. So one thing, that you can see when you look at their numbers is that their expenses are high and their payroll is a huge part of that. So we will decrease the size. And so we'll kind of interview the current staff. There's 2 property managers. There's 4 different guys on the maintenance side. We're looking to keep 1 property manager and at least 2 of the maintenance techs, maybe 2.5, maybe keep 1 part-time because they do have, I think 1 or 2 of their guys are part-time right now. So that's, we're going to decrease the team size. Keeping property management in-house allows us to keep high standards and control costs. For instance, we commit to a 6% property management fee, and that really includes basically everything. There are very minimal administrative costs outside of that. You look at the current management setup, the way the seller has it set up for his property management team. I think their fee is 5%, but when you add in their marketing costs or administrative costs, it's actually 8% with all those things. So we're going to be, 2% cheaper, and 2% on right now it's around $1.7 million. You're looking at $35,000, something like that in savings just from the property management fee. So as far as the capital expenditures, the CapEx projects, our primary focus will be the unit turns. Now, again, like I said, these units are in good shape. They don't need a whole lot. They just need, kind of a refresh. So even though we plan on, doing 50 units to a little bit higher level, we're really still expecting just to spend $3,000 per unit turn on the bigger turns. Then the lighter ones, we really expect to go in and spend around $1,000, $1,500. So unit renovations are a big part. I kind of mentioned, the parking lot just needs some repair. We've already gotten a couple quotes. One was just over $32,000. The other one was $20,000. But we do think we're going to need to do that, pretty much immediately this next spring. And then we'll need to come back and do that again in a few years. So that's why we have a parking lot at $100,000. We know there are some decks that need repairs, well, actually really replaced. And so we've got a quote for that already. That's 35,000, or sorry, $3,500 per deck. We plan to do 20 of those. They do them together, so they're stacked on top of each other, and they're going to reset the post and kind of redo that. So we plan on spending $70,000 on that. The hallway just refreshing with paint. Our plan right now is to buy our own machines. The seller shared that he has moved the current laundry contract to month to month. And his plan was to get his own. And so we've done that before. And so we look to do that again. That would double our income, because right now the company that provides it, of course, they keep half of the income. So we see some upside there. And then, of course, we've got a contingency because things never go as planned. Things always cost more. So we've got another 110,000 that we don't really have a specific spot for, but I'm sure we'll spend it in some way. So again, the unit turns, we expect to do 36 per year. That's just built into our expenses, and I'll show you that on a later slide. And just at $1,500 per turn. That's just a very quick turn, touch-up paint, carpet, appliances, things like that. We'll keep that in-house. The maintenance guys that we hire, the 2.5 that we keep on staff, they can handle those. And then we do kind of what I would call light renovation. That would be 10 per year, so total 50. That's more like spending $3,000 on average. Again, some a little bit less, some a little bit more. Now maybe a full paint, putting in some LVP, maybe replacing an appliance, doing some work in the bathroom, and then of course we know there are going to be furnaces, there are going to be water heaters that we have to replace, not very many, but that's going to happen. And so that's when you're spending more than 3,000, of course. And so we'll partner with local contractors on this, and use some of their services in conjunction with the guys that we have on site. Again, I know I want to move pretty fast, just because I don't want to take up too much of your time tonight, but feel free to stop me if you have any questions. So just getting into some of the numbers, what I'll say about this, we do plan to increase revenue, but like I mentioned before, not a whole lot. This isn't a big push. This property is already, performing pretty well. I don't expect market rent to increase. And I believe this is where we can show that we truly do, underwrite conservatively, and our projections are conservative. And you can see there at the top line up, that's how much we expect market rent to increase over the coming years. So in general, a multifamily operator is going to expect 3% rent increases per year. In 2026, we're actually expecting 0%. And then 2027, just 2%, because again, that's what we're seeing at our properties. We're not seeing a whole lot of rent increases. And I think the economy is kind of in a tough spot, at least for our renters, our demographic. And I expect that to continue for a little bit. So I do think, things will come back, but we want to underwrite conservatively. And so that's what we're doing here. So the third line is our market rent increases. And you can see our average rent, that's going to increase, of course, as we're bringing more and more residents up to the market rent, but we're always going to trail the market rent just a little bit. Again, conservative underwriting, current operations, if you take into consideration all the vacancy, the bad debt, the delinquency, things like that, it's running about 6.5%. We're underwriting for 9%. And so we're being conservative there. We do plan on instituting more of a utility fee at this property. They're currently using a service that bills the residents back. We like to keep that in our control and just pay for the water, sewer, trash, but then do a fee. So that's the way we'll be doing things. So that will increase the utility fee. And so you can see there how we're going to increase revenue over the coming years. These are not significant increases. You can see year one is actually not a huge increase at all. That's actually pretty minimal. A big part of that is because, we're expecting to have higher vacancy, delinquency, bad debt. I actually don't think we will, but that's how we underwrite. Expenses, this is where you can do value add without having to increase rent, because we're going to control our expenses. So I already talked about how, our property management fee, our administrative costs, our advertising are much lower than others. And so the current owner is about $140,000 per year. We'll be at $111,000 in year one. So that's $29,000 in savings right there. Again, decreasing payroll. You can see, we expect to decrease payroll by about 50,000. That's one person. And we just know with our other properties, we can operate 180 units with one property manager, especially one that's stabilized like this. So I feel very good about that. Taxes. Talked about this before. We've been burned on taxes. We are expecting to be. We're underwriting to be burned again. I actually don't expect this. The current seller, he's owned for over 5 years. They've never had a big tax reassessment on this property. So expecting things to go as it has for them. And he shared with me the previous owner hadn't. So again, this is one thing we like about these tertiary markets. The properties that I mentioned that we kind of got dinged on, those were all in Dayton, in Montgomery County, where they're just more aggressive. They're less aggressive in tertiary markets. So not really expecting this, but we want to prepare for it. So our underwriting says that our taxes will triple in year two, because they could, because this property is valued much lower, 1/3 of where we're purchasing it. So they could do that. And so we're going to underwrite for that. Obviously, if it doesn't happen, the returns are going to be much better. So you can see the expenses here and how they jump in year two, because we expect our taxes to jump. So that's on the expense side. And so that bleeds down to the cash flow. One kind of unique thing we're going to do for this property, we've done things like this, but we'll typically have just kind of a certain amount that we're going to hold back for reserves. This property, we feel that the best thing we can do is actually hold back even more. And so what that's doing for us is kind of evening out our returns. So you can see we're holding back a lot more in year one than year two, because year one, we're expecting taxes to stay relatively where they are. And then if we got that big increase, it would be year two after, the auditor catches up to us, hey, this property traded, and we'll do some things to kind of hide that. There's the way Ohio works, how you do that. But if it increases, then we would hold back less reserves in year two and just kind of keep the returns minimal. The other thing that holding those reserves back allows us to do is put us in a position to pay out more, but also still have a lot in our CapEx reserve account when we do our refinance. So I'll talk about that a little bit later. But you can see the net operating income. Our mortgage, we are expecting 1 year of interest only. The broker thinks we might get 2. Very confident we'll get 1. So we're underwriting for 1. So you can see the mortgage jumps a lot in year 2. That's another reason, we can hold back a lot of reserves in year 1 because, low taxes and interest only. But year 2 and beyond, not so much. We do take an 1% asset management fee. That's to kind of do all the things that it takes, to run Threefold Properties as an asset management company. So there's our cash flow. You can see the investors' return. That number is very similar to the cash flow number. So like I mentioned, the limited partners, all of you're getting 92% of the cash flow in years 1 through 5. So there's the cash flow that we're expecting, starting off between 8 and 9%, depending on Class A or Class B investors, and going up over 10 and to 11%. Our plan involves a refinance, a cash out refinance within 5 years. So typically that happens before year 5. Again, just to be conservative and to under promise and over deliver. We always set it right at year 5, just like our sale is set at year 10, even though likely, things move quicker than that. So when we refinance in year 5, we're being pretty conservative here. We're valuing the property at a 7.5% cap rate. That's pretty conservative when you're refinancing, because when you're refinancing, you can keep numbers as they are. When you're selling, the buyer always has to assume that taxes are going to increase, insurance are going to increase, things like that. So you can typically refinance better. So, we have that new loan there. Again, kind of same thing, expected another loan, similar, 75% LTV, 5.3% interest. There's our remaining debt. So our refinance proceeds would be $3.2 million. But with all the reserves that we've accumulated, that $645,000, that all comes from what I just explained on that previous slide, where we're holding back reserves. That money, along with the refinance proceeds, would allow us to pay back 90% of investor capital. So just 10% of your capital would stay in the deal. But then also we'd still have $345,000 that we're going to now have to spend on CapEx in years 6 through 10. So again, maybe we need to do more with the parking lot. Obviously we're going to do more units because they're going to keep coming up, right? And maybe the siding needs done at that point, things like that. So we want to, make sure we're replenishing our CapEx fund. When you get your money back, you stay in the deal. You don't lose any of your equity. You don't lose any of your position. You've just got your money back now to go put in another deal. So we really like the refinance option. After you refinance, like I said, you stay in the deal, so you continue cash flowing. Years 1 through 5, there's the return that you'll experience. Years 6 through 10, the return goes down because two things. One, the mortgage is much higher, right? Because we've got a bigger loan. That's what allowed us to do a cash out refinance on the much higher value. But then also the preferred return goes away. So once you get your capital back, then you don't have a preferred return on that capital. Now you'll have the preferred return on the 10% that's still in the deal, but so you get your 8 or 9% preferred return on the 10% you still have in the deal. But then after that, and it's just a small hurdle now, then it's just a 60-40 split. So again, this is, like I said, I feel like this incentivizes us general partners to do really well, to make the property worth more, to pay you your preferred return, get a good refinance, get a bunch of your cash back, if not all of it. And then now we get to experience some of the cash flow instead of, you all investors taking 92% of it. Now you're getting a little over, but about 60% of it. We're getting 40% of it. Meanwhile, your cash is back and now you can go invest in a second deal with that same cash, right? So this is what the return would look like in years 6 through 10. Sale after 10 years, again, being conservative, we got the cap rate on the sale at 8%. So again, feel like that's pretty conservative. We are buying it at 7.7. I think there's some reasons around that. I don't anticipate that we'll sell as high as an 8% cap rate, but if that's what we're underwriting for, that's just at $94,000 per unit with an average rent. Our expected average rent would be getting close to $1,100. So I think that's a good deal for the buyer. And so that would put our value just under $17 million. Again, we're buying it for 11.4, so a lot of value there. With that remaining debt, the investor's profit from the sale would be 3.7 million. So we raised 3.9, so a 95% return on your initial capital. But of course, remember, that's a 95% return on that initial investment that was returned at year 5, or at least 90% of it returned at year 5. So, of course, if we were able to sell at a 7.5% cap rate, we would sell for about 18 million, so over $1 million more. That'd be 112% return for the investors if we can do that. So I don't think that's very unlikely. But we didn't underwrite it that way. So if things don't go as planned, because they never do, right? Like, how are we kind of protected? Yes. Brandon's asking about an IRR after 10 years with these numbers. Yes, I'll get to that, Brandon. Great question. That's coming on a later slide. So if things don't go as planned, of course, we've got our CapEx and reserve funds. So CapEx, $525,000, on average, we're adding another $129,000 in reserves. So of course, yes, we've got that CapEx, all of it except for $110,000. Hey, we want to spend it here, we want to spend it here, but we don't have to. So if things don't go as planned, we can always pivot and move that money, right? We don't have to renovate units as nicely. We don't, the parking lot's actually in pretty good shape. We don't have to buy laundry machines. We can keep going with the way things are. Those reserves, hey, we want to hold on to those because we want to be able to do a bigger cash out refinance, but something catastrophic happens. Of course, we spend that money and maybe our refinance only gets you 80% of your capital back, right? And so not as good of an outcome, but we've got a lot of safety built in with the reserves that we're starting with and the reserves that we're adding as we operate this property. Of course, we're going to have a fixed interest rate, so we're not going to have interest rate risk with this investment. Our interest rate is going to be fixed. Our break-even occupancy is 67%, and then it gets better as we increase income and hold expenses steady. So that means, if we lose 30% of the residents, we're still paying all of our bills. So I don't know that this property's ever been that has had that low of occupancy, but we would still be fine at that. So that gives us a lot of feeling very safe there. And then because we are using Threefold Property Management, because property management is in-house, we really can control a lot of the costs. I've kind of already talked about how we're doing that already, but of course, we could always do more if we had to. And then the last thing I'll say is just, you can count on the general partners being the backstop. So we've done this before. Some of our earlier investments where we didn't have the reserves that we probably should have. Took on some massive tax hits where we had to pay huge tax bills right now, and those properties needed a little bit of help, and we were there to lend the money to those properties just to get it through that spot, and turned out great for us and our investors. But that's the kind of backstop that we're there for. So I can just tell you that threefold, and then I know level 5 capital, very similar. Like, we're there when needed. So I would just say that we've done it before, we would do it again. Okay, so how do you fit in your investment? So you can invest with cash out of your savings. If you liquidate another investment, you can do that. Whatever you're investing in, you can invest as an individual. You can invest through an LLC. You can use a self-directed 401k or IRA. Many of you have done that already. So a lot of different ways to invest with us. And then we're going to have 2 investment classes. Done this before. So if you want to be a Class A investor, that means you're investing at least $500,000 into this, and Class A investors will receive a 9% preferred return. Same equity split, just a higher preferred return. Class B investors, that's anybody that's under $500,000. The minimum investment is $50,000. You'll receive an 8% preferred return, and then that 60-40 equity split. Distributions will begin in Q1 of 2026. That's when they begin accruing. So if we weren't able to do, hit that 8 or 9% in Q1 because we're purchasing a little bit into Q1, then that accrues, and we've got to catch that up. As many of you know, we do our QBRs, our quarterly business reviews, every quarter. We do distributions every quarter, and then we jump on a webinar every quarter, invite you all to come in and say, hey, here's everything that happened during the quarter. Here's all the numbers during the quarter. Here's where our bank accounts are at during, by the end of this quarter. We really just try to lay it all out to you. If you can't attend, that's fine. We always email it out so that you have all of the information and you know exactly what's going on with your investment. Okay, sorry. Thought I had another question, but looks like I answered that one. Okay. So what would it look like? Just I kind of gave some numbers, but it's usually easier to look at it, from your perspective as an investment. So those top 3 lines there, the top 3 rows, that's a Class A investor. So if you were to invest $500,000 in this deal, your cash flow, your profit in years 1 through 5 would be $240,000. So that's a 48% return. At the refinance, you get 90% back. So that's $450,000 back. Years 6 through 10, then you're making another $170,000. That's 34% return. Again, that's a 34% return on $500,000, but you've got 450 of it back. So it's obviously a much better return on the 50 that you have in the deal. And then at the sale, of course, you get your other 50,000 back. You get $475,000 of profit. That's a 95% return. So your total profit is $885,000. That's a 177% return. In case this is confusing, you don't turn 500,000 into 885,000. 885,000, that's all profit. You turn 500,000 into 1.385 million. So, yeah, that's the difference between the profit and what you end up with. When you started with 500, you end with 1.385 million. So if you invest 100,000, Class B investor, your profit in years 1 through 5, 43,000, again, 43% return. You get 90% of your capital back at the refinance. Your cash flow in years 6 through 10, 34,000. The sale, get the rest of your money back, get that 95% profit. So, very similar numbers, 172% return. So again, 100,000 plus 172,000 in profit, your 100,000 becomes 272,000 through this investment. So some of the numbers that we're asking about return on the investment. I like to think of multifamily. I think when it works well, you get money now and later. The money now is the cash flow. So the average cash flow, this is years 1 through 10, because years 1 through 5, the cash flow is well over 8%, well over 9%. But throughout even the whole 10 years, it averages between 7 or average 7.7 for Class B, 8.2 for Class A. So it's great cash flow, great money now. I mean, you could spend that now if you wanted to, but then you're also building a nest egg, because as you're building equity, 10 years from now, you get a 95% return. So that's kind of building a nest egg for you, holding that money for you, that 10 years from now, you're going to have a 95% return on whatever you invest. So that's kind of the money now, money later. You can see some numbers there, the total return on investment, the average annualized return, 17.2, 17.7% for Class B, Class A. Equity multiple, kind of saying the same thing a different way. The IRR is just over 17% for Class A, just under 17% for Class B. So you're nearly tripling your money in 10 years. If you did this twice, this is how you compound wealth. If you did this twice, you did Pine Bridge with us and you did another one just like it for the next 10 years, then in that case, 100,000 becomes 740,000, 500,000 becomes 3.8 million. So, the returns get really good if you keep putting the money back in, right? And you guys know how that works with compounding returns. So if you're interested in investing with us, it is open now. I've got everything set up in our investor portal. That's Invest Next. So you have to log in to Invest Next. Most of you, I think, have an account already. If you don't, you'll have to create an account in Invest Next, but you can log in there. Of course, you review this presentation, you review it with your spouse and advisor, whoever else. The legal documents are all in Invest Next. So when you log in, you can see the deal room there. I'll actually show that to you guys here in just a second. So review the legal documents. I've got those highlighted with what I think are some of the most important areas. And then you fill out a subscription agreement. So you do that right in Invest Next. Again, I'll show you that real quick. And then once you're done with that, you can do ACH right through Invest Next, which most of our investors do, or you can print out wiring instructions and you can wire the funds from your bank. I always tell everybody, call me, make sure you got the right numbers before you send that wire. But that's how you can get in on this investment. Just wanted to summarize real quick, gone through a lot. What is Pine Bridge? Why do we think it's a great investment? We really feel like this is another property that's in Threefold's wheelhouse. That's Threefold and Level 5 Capital. This is workforce housing. It's a tertiary Midwest market. It's a value add opportunity. We can increase the revenue, although minimally. We're not, we don't have to even get that aggressive, and we can decrease expenses on this one, even more so than a lot of the other projects we've had. We think these are good buildings in a good location. They're brick. They're slope shingle roofs. We think they're attractive layouts. You got private decks, patios. It's a small city or a big town. It's close to the highway. We've got good jobs there, good incomes that support the rents we're going after. We think we're getting this property at a great basis with positive leverage. We're buying it at 7.7% cap rate. We're buying it for what the seller has into it. We're getting a fixed interest rate, 5.3% or below, which means we have positive leverage of 240 basis points. We think this is low risk, but we think the returns are going to be great. Break even occupancy at 67%. That's awesome. We have in-house control. We've got a fixed interest rate loan, so the low risk, but great cash flow years 1 through 5, over 8.5% to 9.5%, 90% of your capital return at year 5, take the risk off the table at the refinance, and then a big, 95% return on the sale in year 10. So low risk and high returns. Whew. That was a lot.
I was just going to have you mention that that the link for investing with us is different than your link.
Yes. Yeah. Thanks for pointing that out. It's a very specific link, as you could see in that. And I stopped my sharing, but my link says Threefold. Jeff's link will say Level 5 Capital. So that's an important distinction, Jeff. Thanks for saying that. And I'm bringing that up now, but actually, I'll go ahead and do that real quick. So I'm just going to share my screen again, just to show you guys real quick. So, this is an example. Again, this is an example of Threefold because it says Threefold right here. So if you're one of Jeff's investors, when you get on to the right Invest Next site, it's going to say Level 5 Capital up here. But, this is my login here. So when I log in, I'm going to see that, I've got a new offering available here. This is Pine Bridge. So I can click on View Offerings right here. I could also click up here on Offerings and I'm going to see this. I already started filling one out because I was creating a video for you guys, but you won't see two like that. But you come in here to the deal room, you can see the private placement memorandum, the operating agreement, the subscription agreement. I've created a video on how to fill out the subscription agreement. So all those things are here to review. You need to review those and make sure you feel good about those. I will say they're nearly identical to the ones we've had in the past. So if you've invested with us before, you've seen all these before, you've seen my highlights, but of course, go through them again. And then when you're ready to invest, you just click right here, invest now. Again, I already started one, but you would start a new investment. You won't have to do all this because you haven't started one. But as you do that, it's going to start asking you questions, Class A or B. Remember, Class A is 500,000 and up. Class B under 500,000. So I'm not going to go through all this, guys. I don't want to do that tonight. I've got, again, I recorded a video where I go through all that. So you guys can watch that if you need explanation. If you guys have done it before, it's probably going to be pretty easy for you. So yeah, any questions? Be happy to go back to any slides or review anything. I really,
Hey Lee,
yeah, go ahead, Jim.
what's the latest date to invest on this?
There's really not a specific latest date, Jim. It is first come, first serve. I was going to say that, and I do think this one will go pretty fast. We sold a property in October that returned quite a bit of capital to our investors. Actually, we sold another little property in October as well, or maybe that was November. October, November, return more capital. It's been, about a year since we had an offering. So I really do expect this to go fast. I know a lot of Jeff's investors are anxious to get in as well. So I wouldn't be surprised if this investment wasn't full by Christmas. So that's really the deadline, it is first come, first serve. Now, you don't have to have the money in by then. So that is two separate things. So I should have already said that. So I'm glad you asked that, Jim. That is getting into InvestNext and filling out the subscription booklet. Now, I ask that you don't do that unless you're sure you're going to make that investment. So of course, get your stuff together, talk to talk to your spouse, talk to your advisor, all the things. But once you decide, hey, I'm definitely going to make $100,000 investment, then go ahead and fill out the subscription booklet. You don't have to immediately wire your funds to us or do the ACH transfer. We do want that to happen quickly. I would say it's definitely easiest to just fill it out right when you're done filling out the subscription agreement. InvestNext will say, hey, you can do your ACH transfer right now. You can go ahead and do that. Most people do. You don't have to. So we really do need the funds. I would say really early January. We expect to close mid-January. We really need to have the funds, obviously, in the account to be able to close. So I'm going to be the people that fill out the subscription agreement. I am going to be kind of hounding you a bit, at the end of December to get your funds in. So we would really appreciate, we'd appreciate you just put your funds in there, immediately as you fill out the subscription agreement. That's kind of the expectation. But if there's a reason that you can't, there is some leeway there. But if you really want to get in, I would get that subscription agreement filled out at least to save your spot, because I do think this will go pretty quickly.
All right, thank you.
Yep. Yeah, thanks for that question. Any others?
I want to say just real quick, Lee, that one of the things that hit me the hardest when we were on the site, on the premises, on the property, was all the new roofs on all the buildings. And they had redone all the soffit, fascia, gutters, all that. And, that's such a huge expense.
Mm-hmm.
And they had done that like so recently that's something that we're not even going to have to think about as owners. So
yeah,
I really think that's a huge, huge thing.
It is huge, Jeff, because that's money that doesn't really help you increase rent. Right.
No.
That's the money that you never want to spend, but you have to. Somebody has to, and I'm glad it's not us. Because they did, and I was actually pulling this up. Oh, I have it. They put it in the one. Okay, well, they've spent 1.2 million in exterior upgrades. So obviously, a huge part of that is the roof. So yeah, to your point, Jeff. I mean, they spent a lot, and they did a good job. I mean, like just
Oh,
the roofs really look great. The fascia, the soffit, the gutters. It looks sharp. And so we're going to benefit from that, but we don't have to spend that 1.2 million. We can spend most of it on unit renovations and the things that the residents really see when they go into the unit, the things
right.
they really care about.
Yeah,
So that's awesome.
absolutely. Yeah,
No,
it
good
is.
point. Okay, well, I won't hold you captive. If you don't have any more questions, we'll go ahead and end this for tonight. Of course, let I'm going to share real quick one more time. I mean, you guys have this information. There's Jeff and I's contact information. I think you guys all have this anyway. If you don't, there it is again. Of course, feel free to reach out to Jeff and I with any questions. If you have questions about Pine Bridge, about how it works for you as an investor, or you need help at Invest Next, we're used to that too. I think it's pretty user friendly, but it can be confusing. I actually worked with our syndication attorneys to change the questions a little bit. I thought there were a couple questions that were confusing in the subscription agreement, so we did change a couple to make them not confusing. So hopefully that's a little bit better, but feel free to reach out if you have any questions about that. We'd be happy to help you out.
Cool deal.
Okay. All right. Well, thanks everybody. Appreciate you all
Great night.
joining. We're excited to partner with you all again.
Thank you, Lee.
Thanks, Lee.
Yep. Take care. Have a great night.
Good night, guys.